you're self-employed and thinking about buying a property in the Lowcountry of South Carolina, Hilton Head, Bluffton, Beaufort, you may have heard that being self-employed makes the lending process a nightmare. Maybe your accountant has told you your income's too low on paper. You've had a lender somewhere say you don't qualify. Well, understand, being self-employed is not the death of any deal. There is absolutely lending out there for individuals who are self-employed. In fact, mainstream lending, Fannie Mae, Freddie Mac lending, FHA, VA, USDA, all of these platforms will allow individuals who are self-employed to purchase property. And in addition to that, there's a whole bunch of options out there today specifically designed for self-employed borrowers. If you are a small business owner, a real estate agent, a contractor, short-term rental manager, this video is for you. I'm gonna walk you through kind of the nuances or the differences, the struggle, maybe the rub of what your accountant says versus what your lender says, how mortgage banking looks at tax returns, what is utilized to qualify, and then I'm gonna give you some steps so that you are best prepared in order to make your purchase. Let's turn that idea of a nightmare into a positive event. So stick around because we're gonna get after it right now. So the real crux is, why is self-employed borrowers, why have we heard that self-employed borrowers have a struggle to begin with? Well, it's because, think of it, if you have a W-2 and you give it to your mortgage lender, they read their W-2, and really all they have to discern is, okay, of this W-2, what is salary, what is bonus, what is commission, and you break it out. When you're self-employed, you get a tax return, and maybe it's your personal Schedule C, maybe you have an S-Corp, maybe you have a partnership, maybe you even have a corporation. Nevertheless, being self-employed lends a whole new realm of income. And of course, every year you have to work with your accountant to build income that you are ultimately taxed on. Now understand, what the CPA or your CPA looks at through a lens of your tax return and what the mortgage lender looks at are going to be different. You can understand that your CPA, their job, their goal is to be able to work through deductions and things of that nature so that you are taxed the least amount. That's what you pay them for, so that you don't have to pay an exorbitant amount of taxes. Well, that same number that is on your tax return, your bottom line. Many times people will say to me, I ask, how much do you make? And they said, I made $200,000 last year. And that is just gross receipts. That is before deductions. Mortgage lenders will take into consideration the net income after deductions. And that number is what you are taxed on, and that is the number that the mortgage lender will utilize for qualifications. So understand that there is a bevy of write-offs that someone can have, but I'm going to give you a tip. As a mortgage lender, we can actually add back non-cash deductions. So the number one, the biggest one, is called depreciation. Now that is not something that that is a write-off that your accountant gets to use, but that is not something that you actually, this is a paper loss, if you will. A paper write-off. So let's play this out. Let's say that you are self-employed and your net income after all deductions was $110,000. $110,000, but I looked and you had depreciation was $40,000. I actually get to add back that depreciation. I get your net of 110 plus the 40,000, and that gives me a qualifying income for you of 150,000. Now, I don't want to simplify things too much. It's not as simple as, oh, let's just look at the bottom line of net, add back the depreciation. There is a slew of other calculations that the mortgage lender has to utilize for you to be able to qualify and come up with your actual qualifying income. Nevertheless, depreciation is the easiest one to tackle. So the question isn't, I'm self-employed, can I actually qualify? The real question is, how does my income look on paper? What can I qualify for based on what you see on my tax returns? So the first thing a lender is going to do when you're self-employed is they're going to ask for your 2 most recent years of tax returns. They want you to be self-employed for 2 years because they want to establish a trend. So let's envision that you made $100,000 in year 1. Again, we're talking net figures. And then in year 2, you made $120,000. So technically that's 100 plus 120 divided by 2, you make $110,000 annually. Easy calculation. Mortgage lenders that's basic stuff. Now the next one gets a little bit trickier. Let's just say your income went down. Let's play it out. Let's do an example. You're a real estate agent. You made $120,000 in year 1. Why? Because when you got your license, you had friends and family who happened to buy, and sell real estate. And then in year 2, of course, they weren't going to buy and sell again in the next year, and your $120,000 went down to $100,000. Well, mortgage banking guidelines says we are supposed to take the most conservative approach. We're not supposed to take a 2-year average when there's a decline. We're supposed to take just $100,000. So if your lender isn't asking you questions or talking to you about that, that's a red flag. That is certainly something that comes up. Now, recognize there are times when things are extreme and things happen, and there are explanations so that you can utilize maybe an average or something along those lines. I'm just giving you some general basic examples. Now, another example of Fannie Mae and Freddie Mac, or a guideline that is beneficial. Let's say you are self-employed for 5 years. You actually get to use the most recent year of tax returns. So no need to study trend. You've been in business long enough, so you get to use the most recent tax return. One thing that I have seen, you have to be very careful to this, is remember when you are self-employed, whether you're getting your S Corp, you're just filing as an LLC through your personal return, partnership, if you are self-employed, you have to have your taxes filed by October 15th. So if for 2025, anybody who wants to utilize 2025 returns off into the future, those have to be filed by October 15th of 2026. I'll give you an example. I just worked with somebody and their 2024 returns are not yet filed. Well, that's a problem for me because I need, since we've passed October 15th of 2025, they need to have those 2024 returns in the file for me to be able to actually calculate their income. Those are deemed late, if you will, and they need to be filed. So keep that in mind. If you're self-employed, make sure you get your taxes in by October 15th. Extensions are perfectly fine. Like I would be able to close a loan right now with somebody who has not filed a 2025 return because we're not into October 15th or past October 15th of 26. So I could do that now, but remember, as the timeline goes on, just keep that in mind. All right, now I want to talk to you about some other programs out there that are going to be very helpful. So, you had the 2-year average of self-employed income with Fannie Mae, Freddie Mac. Maybe if you've been in the same line of work, even like let's just say you were the manager of a construction company, you were the general manager, you've been doing that for years, and then suddenly you decided to open your own construction company. Believe it or not, I could actually use a 1-year tax return on that. Yes, you have not been self-employed for 2 years, but you have been in that same line of work, and I'd be able to utilize your most recent year, a 12-month of tax returns because you're in that same line of work. Still mainstream lending, but let's just say there's some other options out there for you. Like let's say your accountant went through and there was a ton of deductions and suddenly your $100,000 income on paper was $30,000. You can't buy a house. You think, well, guess what? There are things out there called, or programs out there called bank statement loans, where I'm able to utilize a 12-month or 24-month average of your income utilizing bank statements. So I'll get your 12 months of income, bank statements, I'll utilize an income, I'll look at what's coming in, I'll assign a multiplier, or I'll do the same with 24 months. Guess what? You're allowed to have as little as a 15% expense ratio. So if I looked at your income and you made $100,000 in 12 months, I then get to multiply that by 0.15. That's my little deduction for expenses. You made $85,000. I'm gonna give you a perfect example of when I use this. I have an individual, he has multiple businesses and his accountant does a great job. He has a solid amount of write-offs, and on paper, he had $120,000 worth of income utilizing his tax returns. He was clearly frustrated. I said, let's look at a bank statement loan. His income, he made $120,000 for his tax returns a year. His tax return, his bank statements had him making $85,000 per month. So that individual went from, I can't make it work, to you can pretty much buy whatever you want, making $85,000 a month. Of course, we turned his frown upside down, and he is now happily into a house utilizing a bank statement loan. Another program that individuals who use if they want to buy an investment property is a DSCR loan. I've touched on it in other videos. A DSCR loan is when you look at what the property can generate on a revenue basis, meaning what it brings in on rent, versus the principal, interest, taxes, insurance, and HOA/condo costs. So it just looks at what it costs to rent, what it brings in versus what it costs you. So Another option, again, where you're not using mainstream lending. So two really, really good options there. So I just hit you over the head with a whole bunch of information. I said, okay, Fannie Mae, Freddie Mac, VA, FHA, they want you to have a 2-year average of income if you're self-employed. I then said, hey, there's some alternative programs out there. You know, you only need to have 2 years worth of self-employment and you can utilize the most recent year. Fannie Mae and Freddie Mac allow for 1 year of tax returns if you've been self-employed for 5. So just hitting you over the head with a whole bunch of information. I then said, hey, bank statement loans, great option out there. Shared a story with you where someone turned into a buyer after an original no looking at the tax returns. And then we talked about DSCR loans where it's the investment, what the property can rent for versus what it actually costs you on a monthly basis. So some really nice options there. Well, what would you do? What should your takeaway be if you are self-employed and you wanna qualify for a mortgage, qualify for a house? I think you need to be proactive. 6 to 12 months in advance, you probably have an idea. Plant that seed because your CPA and your mortgage lender are going to be looking at your tax returns their same taxable income, but kind of through a different lens. Of course, your CPA wants you to pay the least amount of taxes and your mortgage guy wants you to have a lot of income because then you can qualify for more. So make sure that the CPA and your mortgage lender are married together and they're seeing everything in the same light so that you, your lender, and your accountant are all on the same page. Keep quality notes, keep that profit and loss statement up and running. You can imagine if you're utilizing a bank statement loan, underwriters love to see consistency. They don't want to see large unexplained deposits. They don't want to see overdrafts. So keep everything on the up and up, keep everything organized because it will make your journey go much, much smoother. My name is Aaron Benton. I'm a local mortgage lender here in Hilton Head, and I serve all of South Carolina, North Carolina, and Georgia. I'm happy to take a peek at your tax returns. I work with self-employed borrowers every single day. I actually have an individual, she came to me, she said, I don't want to buy a house. Buying a house is way too hard when you're self-employed. We are on loan number 3 for this individual. Of course, she's still self-employed, and at this point with her, she just hands over the returns and everything goes according to plan because she knows that I know exactly how to read those returns. So if you want me to tell you what you can make, what you qualify for utilizing your tax returns, maybe it's a bank statement loan, happy to talk to you about DSCR loans as well. Tap the link below, set up a call with me, set up a meeting. Love to understand your personal situation. I hope one day to get to meet you, but if not, I hope to at least see you on the next video.